Hello and welcome to another Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com, and in this video I'm going to show you how you can use the opening range on the bonds to help you know when it's not the right day to try and buy the dip in stocks. All right, but before I show you that, I want to make sure you can see this video clearly, and if you're watching it through YouTube, you'll want to go down to the lower right hand corner of your screen. There's a little gear there. If it doesn't say HD next to it, click on the gear and it'll enable you to elect HD. The video will be much clearer. I think you'll like it a lot better. And if you're just finding us on YouTube, please make sure you check us out at www.marketgauge.com/tutorials, where you'll find more videos like this and a whole lot more free resources. So let's get started. You're looking at the TLTs, which is the ETF that covers the longer term bond, 20 years. And the critical part about this chart is the rate of decline here, right? So if bonds are going down, interest rates are going up. And without going into a whole course on interest rates and the relationship of interest rates to stocks, the key thing to watch is the rate at which bonds are changing. So if they're really in a strong trend, then they're more likely to have a stronger impact on stocks. So with that in mind, the daily picture here is a pretty significant sell-off, a rally back up to the 200, and then what we'll see yesterday was a big gap down. And when you got a big gap down, then right there in the morning, you want to figure out whether or not this big gap down is something that the market is going to fade, in other words, going to buy, or is it going to turn into a big day down? Now, if you get a big day down in the context of a strong trend down, unless it's happening for a reason that is actually good for stocks, it's probably not going to be the right day to try and buy the lows in stocks, which is what we covered in a recent webinar called Advanced Tactics for Buying Near the Low. So, and if you didn't see the webinar, well, this will still be helpful. If you did see the webinar, then this is kind of an add-on to what we were talking about in the webinar. So now that you see the picture in bonds, accelerating down, opening lower in the context of a downtrend, let's take a look at how the intraday action played out and how the opening range could have I guess save you from getting yourself in trouble. All right, so we're looking at yesterday's price action, and we have the bonds over here, the TLTs down here. So you can see they gapped lower. We're on a 5-minute chart, and the green line in each of these charts is the opening range high, 30-minute opening range high. The red line, 30-minute opening range low, and you can see the bonds in their downtrend, the SPYs in the upper left, the Qs in the upper right, and the IWMs in the lower right. So just to quickly assess what was going on in each of the markets, we look at the first half hour, and if we look at the first half hour, these are the ranges for each of our instruments. Okay. Now, I'm not going to go over the specific, reteach the whole entry pattern on the lows. If you didn't see the webinar, it might be available. Maybe I'll link to it at the bottom of this. So the key here is we can see that the SPYs establish a range and they're trying to bounce off it. The Qs establish a range and they're trying to bounce off its low. The IWMs actually establish a range, and they're actually pretty strong. In fact, they take out their 30-minute opening range high. So this is actually normally a good sign. But look what's happening over here in the bonds. Now, if you just take the basic opening range strategies, if you're in a downtrend in the bonds and you've really broken down below your 30-minute opening range, and you're continuing to trend lower, this is a big warning sign. So you could literally just have a basic rule that unless the bonds really turn around, come back and attack their opening range, stocks are likely to be under pressure. And you can see how that worked out yesterday in the sense that bonds broke down from their opening range low, And if you're a more advanced opening range trader, that would have been a wonderful short pattern. And then when the bonds stabilize, the stocks basically stabilize down near the lows of their day. But then at around 2 o'clock, when the bonds resume their trend down, what happens to stocks? Even IWMs, which were the strongest, get an opening range reversal pattern up near the highs of the opening range, or I should say near the opening range high. They start to sell off, and then that's pretty much it for the rest of the markets. All right, so the moral of the story here is simply that when bonds have a clear direction and they're moving in that direction on an intraday basis for whatever reason that isn't supportive of the stocks. In this case, bonds are moving down. They're not moving down because of any great economic news that is going to have a positive effect on stocks. So that's dragging the stocks lower. That's a day where you don't want to be trying to buy the lows in the stocks, even if it's got the patterns. All right, so hope that helps, and I'll see you in the next video.